This is John Grover. It's February 7, 2018, and I'm just doing a quick video to show one of the methods that I talk about some of the time, which is the top 3 momentum method. You can also use this as the top 1 momentum method or whatever you want, but look in the link that is included with this video just below, and you can click on it and it'll automatically bring you to this free page which shows various ETFs relative to each other. So a few things you have to do to make it easier for you to see. First of all, down here on the bottom right, make sure it says 252 days. That is a full trading year. You notice that each ETF starts at 0 back there, and then you see the relative performance for the last year. The array of ETFs is hard to see here, so I usually click this little icon here where it says Show Histogram Chart. Okay, so here, once again, your days are 252, and you can see the relative performance of each ETF. Of course, their coloration choice is a little weird, so for instance, the REITs are a little hard to see. But you have 20-year T-bonds, aka the TLT ETF. You have the S&P 500 Spiders, SPY is the symbol. You have the Emerging Markets ETF. You have the Commodities ETF, Russell 2000, MSCI EAFE, Gold, REITs, and then my proxy for cash called BIL. And up here you can also see them and unclick them if you don't want to see them. But each month, at either the last day or the first day of the month, depending upon when you're conveniently available, you would log onto this site or just look at this website and pick the top 3, and each one would get 33% of your equity. In this case, it would be the emerging markets would be top, spiders are 3rd, and MSCI EAFE would be 2nd. So basically 33% in each one, and then you're done for the month. History has shown with over 200 years of testing that this momentum method wins over time. It basically beats the standard index. One other little nice feature of this setup is if all of these end up like REITs here, where they're negative over the last 252 days, there's an allocation to this BIL, which is a 1 to 3 month T-bill. Obviously, you're just earning a fraction of a percent interest, 0.75% over a year, but it's very stable. It does not go up and down, and therefore it's a proxy for cash. You can have up to 3 full positions, i.e. 100% in bill when all of these others are down. And that's fairly unusual, say 2008. Crash or the 2000 crash, but that's how this method works. Some of the time, very rarely do you have all the markets down, and therefore you would be out of all of them. And then when you're up, when things are up, you are fully invested. So let me know if you have any questions in the comments, but it's a pretty simple method. It has been shown to beat the index over time, and it's pretty robust given that it's tested for so long. Thanks for watching, and we'll talk next time.